What's going on, guys? It's Killer. Welcome back to the channel. So you're probably wondering, why is Killer swing short? So in today's video, I'm going to be discussing my confluences, or a few of my confluences here, why I expect developing, and obviously my overall plan and bias here. So I believe I created a video 10 days ago discussing why I am building into my short around the 93.9k region. And from that region, we saw a 4.9% drop to our first TP zone. So for those who were following on my X, you would have known that I said, look, there is a very high chance we could revisit the entry. Why? Well, because we're still range bound, plus we are testing around that 90k region. So could I have waited here and waited for the deviation to enter? Yes, I could, but that isn't part of my strategy. Again, we expected this to happen. Nothing is surprising about this movement whatsoever, right? But you'll know how sentiment reacts, right? When you see a significant pump or a significant dump, there's a lot of noise, there's a lot of confusion, and most importantly, this is the area where people flip bias and start aiming for higher targets, 10% above or below, whatever, right? This is how typical market sentiment reacts to these certain moves. But was this expected? Yes. Was it mapped out as TA? Yes. This was all expected. Now that we are seeing this movement, I'm not going to deviate from my plan just because I'm in a little bit of drawdown, right? Part of being a trader is you have conviction and you know where to put your money when the risk reward is slightly in your favor. And in this case, based on my confluences and the overall range and the trend, I believe that the confluence and everything is in my favor. So I'm still in that short. We saw that 4 or 5% drop. We swapped slowly out the position around here, still held 50% of the position. Now we're at this area. We tested scale 1, 2, 3, and 4 again. So average is around where the current price is at the moment, around this area here. As we hit the scale 3 and 4, we did not get up to 5 and 6 just yet, but we could, right? So pretty much what I am expecting, or what we could see develop here, is somewhat of this distribution range up here, where we can see a little range up here, maybe another sweep of the high maximum pains, where everyone's going to be like, oh my god, 100k's next, 102k's next, we're going significantly higher. This is what I'm expecting, right? I'm expecting maybe some sort of a range bound here. Now if you don't want to short, that's fine, but if you are looking for confirmations of a short, you want to wait for the price to retrace below the previous area of resistance here. So if you don't want to short here, that's fine. The proper confirmation is you wait for this to retrace back into the range, then you trigger into that short position. That is the proper confirmation from a structural perspective, right? So this is what you should do if you want to be extremely safe. You might not get the best entry, but you'll have structural confirmation of what is likely to happen here. If we start going on the 4-hour here, you can see how we had a nice rally towards the upside, massive squeeze candle. So obviously we squeezed a lot of people out. And if you start going to the lower time frame, we can see we pushed down, had a little test, pushed down again, tested around here. Now we're holding around this area here. So again, on the lower time frame, we might end up seeing something like this develop, where we can have another squeeze towards the upside, push upwards, and then range back down again. This is definitely possible. This is not something which I am excluding from happening. But if we start going on the monthly time frame and start observing things from an objective standpoint here, what do we see happening around here? Well, we can see we had a nice push downwards. We had an indecisive close. We did not sweep the low. Next candle opens, shaved bottom. We pushed all the way to the upside at the start of the month. Remember, we are at the 14th of a new month, right? We have not had any wicks to the downside. Pretty much we've had somewhat of a shaved bottom here. And we can see we've had a very strong push upwards. So what is the incentive behind this candle? Remember, I look at the market from an objective standpoint. I try to analyze what's the reasoning behind a certain candle and what is it telling us. So in this case, we had a very, very bearish trend. We had sellers slowly, gradually, and stop selling, right? We had sellers losing control here. We had some buyers stepping in at the lows. This was our sign, right, that we could potentially push upwards. Why? It's because we saw momentum gradually sell pressure gradually slowed down. Next candle opens. What's the incentive? Well, it's quite easy, right? We already had a bearish trend. What's the incentive of this particular candle? Well, it's to take out shorts. We saw that movement. We had a strong push upwards to take out shorts. Now, in regards to where this extends to, it doesn't matter, right? It could extend all the way up to 98. It could extend all the way up to 101. Who cares? But primarily, the incentive behind this particular candle here is to take out short positions, and it has done that very effectively. Now, we have already swept the wick high. So, what is possibly going to happen on the next monthly candle in February? Well, the next monthly candle can open, and what we can see is maybe another sweep of the highs, and then the next candle is going to push all the way back downwards. And you're probably wondering, well, why is it going to push downwards and not go back upwards? Like I said again, I observe the candles as a story. Is telling me what is happening, is telling me what liquidity has been grabbed. The trend is bearish. The incentive on this move is to take out shorts. So next month, what we could see here is okay, well, the incentive, we took out shorts. Who's exposed? Well, it's going to be late longs, right? Because the trend is bearish. We already took out shorts. And if we start measuring the move from the previous week low, we are up 20%. So by no means is this a little bearish retest. This is quite a nice bearish retest we've seen here, 20% bounce from the lows. So given that context, the next candle could open and start pushing downwards. Why? Late longs. We've already took out shorts. Trend is bearish. So what's going to happen next? Well, we're going to wreck the other direction. This is the way the market works. We are hunting both longs and both shorts. Now that we have begun taking out shorts, naturally the market's going to be aiming for higher, just how sentiment works. But if you start observing the structure alone, we are mimicking a very similar pattern to what we saw back in 2021 here. And we start measuring, matter of fact, let's get a date and time range here so we can see here. This is the middle range from the wick high to the wick low, right? If we do the same thing on this initial move here, we can see this is the middle range here, which is around 102k. And we can see the price created a very small gap, but did not test that middle range, right? So if we do the same principle here, we are not close to it, but we could test this area in between, which is around 99k, 98k, right? So it's definitely possible. I'm not ruling that out. But like I've said, when the confluence is strong enough and the trend is showing what is going to happen, I like to gradually scale into my position. So what we could see is we could see something like this. And everyone's going to be like, oh my God, we're going to get stopped out here. Killer's going to get stopped. We're going so much higher. The bull market's back. And then eventually, the next candle's going to open and we're going to start hunting liquidity towards the downside. Why? Because the trend's bearish. You can see that the momentum has slowed down. We can see we had a parabolic move upwards and now we broke trend. So what's going to happen? Well, we have structural confirmation the trend is bearish. We can already see that the stock market's creating new all-time highs. We can see gold, silver, all of the precious metals are going ballistic. So it's definitely the perfect time to invest, right? No. Yes, the market can remain irrational longer than most can remain solvent, but the idea is that we pay attention to the structure and avoid the noise. And this is exactly what I am doing here. Now, one last thing before we wrap up today's video, I did bring this up in the last video as well, is if we start measuring the previous all-time high to the bearish retest, we have approximately a 140-day window. And if we start marking dead on in the middle, we have that pivot low at the 70-day mark and that pivot high at the 140-day mark. Now, if we apply the same principle this time around with the 140-day period, bear in mind this happened back here as well on this previous trend. I'm going to just give this example to be relatively quick with this video. But if we see the same thing here, we are dead on in the middle. I brought this up in the last video. We formed a pivot low. I said that we could form a pivot low, and this is exactly what happened, right? So what we are seeing is by no surprise. Are we going to rally up to this pivot? It could happen, which means it's going to probably do something like this, and then that's the pivot where I expect that downtrend to progress. Like I've said, I am building gradually into my position. This is my thesis. This is what I'm expecting. I know a lot of people are aiming for this retest here over a right shoulder and then a push downwards, and we will have to see if that develops. In my opinion, this is too lethal of a push upwards. This gives everybody an exit, and during a bear trend, that's not how things work. You do not give people a chance to exit at a higher price. The whole point of building exit liquidity is the retracements upwards are shallow. So that is my thesis. That is what I'm expecting. Hopefully this helps, and I'll catch you guys later.